Most founders think they lose fundraising deals because the investor wasn't interested. But a surprising number of deals actually die much later, after a good meeting, after positive signals, sometimes even after a verbal yes. And the painful part is that most of those failures were predictable from the beginning. The companion PDF is linked below if you want to study the full framework in detail later, because once you see these patterns, you start noticing them in almost every startup process. This breakdown is really about one thing, where strong fundraising rounds quietly collapse. We're going to look at 5 specific failure points, from the pitch itself to due diligence, all the way to the final wire transfer. And if this kind of practical startup analysis is useful to you, subscribe and turn notifications on. Why? Because these are the kinds of operational mistakes that rarely get explained clearly online. The first problem starts with the pitch deck itself. A lot of founders believe investors are evaluating storytelling first. Usually, they're not. They're pattern matching. That's why giant top-down TAM numbers often hurt credibility instead of helping it. Saying this is a $1 trillion market doesn't prove you understand how customers are actually acquired. The same thing happens on team slides. Founders list titles and credentials instead of execution evidence. Investors care less about where you worked and more about what you've actually built, scaled, or sold. And the ask slide is another major signal. We'll use the money to grow sounds harmless, but it tells investors there's no operational roadmap underneath the pitch. Airbnb became much more investable once they tied funding directly to measurable expansion milestones, not vague growth language. Investors want to see what changes after the capital arrives, because if they don't understand the company quickly, momentum disappears fast. What follows this is one of the biggest mistakes in fundraising meetings themselves. Most founders walk out without defining the next step. They spend the entire conversation trying to say everything, and ironically, nothing sticks. One clear idea usually has more impact than 10 rush talking points. The important question is simple. What would be most useful as a next step? That single question reveals the real evaluation criteria hiding underneath the conversation. And this is where many founders misunderstand investor behavior. Silence doesn't always mean rejection. Sometimes it means there was never a defined process to continue. If you've seen this happen before in your own business or fundraising conversations, I'd genuinely be curious to hear about it in the comments, because this is where a lot of momentum quietly disappears. The next issue becomes dangerous because it feels logical while you're doing it. Sequential outreach, one investor at a time, waiting weeks between conversations. The problem is that this gives investors unlimited time and zero competitive pressure. Good fundraising processes are compressed. Multiple serious conversations happening simultaneously create urgency naturally. Stripe handled early fundraising this way extremely well. They kept conversations moving in parallel, which changed the leverage dynamics completely. Founders who run parallel processes almost always close faster because investors react differently when they know they're not the only active conversation. And if momentum slows down, the smartest move is usually recompressing the process quickly across all active investors within the same week. Then comes due diligence, the stage where founders hear "we're in" and assume the hard part is over. It isn't. This is where operational discipline gets exposed. Revenue numbers that don't match the books destroy trust immediately. Missing IP assignments are still one of the most common legal problems in startups, especially with contractors and early contributors. Dirty cap tables create panic because nobody wants ownership confusion during a financing round. And maybe the most underestimated signal is the data room itself. A chaotic data room tells investors the company is probably chaotic too. Fair or unfair, they connect the two instantly. Dropbox became known for extremely clean operational execution early on, and that consistency built confidence beyond just the product itself. Here's where things become even more fragile. A signed term sheet is not a closed round. Founders relax too early at this stage all the time. Legal drift kills momentum because enthusiasm cools when documents move slowly. Setting a target close date before legal work begins sounds simple, but it keeps everyone aligned under pressure. And the lead investor wiring first matters more than most founders realize. Follow-on investors commit faster to funded rounds than pending rounds. A verbal commitment is still only potential energy until the money actually lands in the account. At the end of all this, the pattern becomes clear. The founders who close rounds consistently are usually not the best storytellers. They're the operators who prepared the process before the first meeting ever happened. Every failure point we covered today is fixable in advance. Subscribe if you want more breakdowns like this, and if you want the deeper implementation framework behind everything we discussed, the full Startup Pitch Workbook PDF is linked below.